Hello, everyone. Welcome. Well, thank you for being here. And I see quite a few familiar names in the audience. Welcome, welcome. And could somebody just in the chat box let us know if you can hear and see us okay? You are able to see the presentation in front of you? And the chat box is located on the left-hand side of your screen. Thank you. Okay, all right. So this webinar is brought to you by Saturn Advice. I am your host today. My name is Joyce. I am a financial advisor at Saturn. So I do hope you get some value out of the next hour and most importantly, have some fun. The topic today is Mid-Year Outlook 2022, how to invest going into a recession. It certainly has been a difficult first half for investors. We have seen high inflation, Russia's invasion of Ukraine, and higher interest rate lead to a bear market for equity and the worst bond market literally in decades. So in this session, we're going to dig into the challenges we face and also what opportunities are lying ahead in the remainder of 2022. More importantly, what it means for your portfolio if you have your money managed by us, or if you are sitting on a pile of cash, what is the way moving forward? We've got our speaker today, Shahrukh Abdali. Most of you on the call would be quite familiar with him. He's featured in our newsletter with his market commentary video. Shahrukh is a financial advisor at Saturn and also a CFA charter holder. He's got vast experience in corporate finance, investment banking, and portfolio management. He is a true expert in this area. Welcome, Shahrukh.
Thanks, Joyce.
Now, before I hand it over to Shahrukh, just want to go over some basic housekeeping stuff. First of all, before you go out there and make any drastic change to your investment, I know that you guys are pretty excited about it. Please be aware that the information shared here are general by nature only. These do not take into account your personal financial circumstances. Secondly, we will be recording the session, which will be distributed in the coming days. You can use that to play back and listen to the key parts. Lastly, we do have a live Q&A session towards the end of the webinar. We will try to save 20 minutes for that. So if you have a question, don't be shy. Use the question box located on the left-hand side of your screen. And as most of you are aware, we've got a chat box as well for the audience, I guess, to kind of interact and engage with each other. Now, without further ado, I will hand it over to Shahrukh.
Thank you. Welcome, everyone, and thanks for those who joined in. Those who couldn't make it will get a recording of this webinar. So Joyce has already talked about the disclaimer, which is precisely that today's webinar is for information purposes. I do not know your specific circumstances, so I'm not giving personalized financial advice. I will be sharing my opinions, but do not go and act upon it as this isn't tailored advice. So get in touch if you want advice specific to your needs and goals. Who are we? Very briefly, we're a group of companies, Saturn. I sit within Saturn Advice at the bottom left, financial advice, investment planning. We've got a discretionary investment management service as well. We have another company called Saturn Invest, which is specialized in UK pension transfers. And then we've got a digital KiwiSaver advice business called National Capital. The beauty of that is that the advice you get out of National Capital is essentially for free because the business model is such that they get paid commission from the provider that they'd be recommending. But on that, what makes us stand out at Saturn Advice is that we are a non-commission business. We are totally impartial in our advice. The only money that we get is from the fee that the clients pay us. We do not take anything from any of the product providers that we recommend. And what really makes this business stand out from the other impartial businesses or independent businesses in the industry is that we do not pay any bonuses to anyone in the business. So I, as an advisor, have no sales target hanging over my head to achieve at the end of the year. So I do not have any incentive to make a sale. I am only interested in providing impartial advice, which is pretty unique, and the right way to do things. We have businesses, we have offices in Auckland and Christchurch. So between those two offices, we cover the entire country. I've talked about the type of services that we offer, and it's a very vastly experienced team across the business. So anyways, getting on with what we are here to talk about today. So I will be going through different asset classes, across shares, property, and fixed interest. And I've divided it in those areas. But before I get on with it, I want to address the main factor that has been, the factor that's been affecting financial markets, which is actually inflation, elephant in the room. So we have obviously seen headlines that inflation is high. It is actually multi-decade high, and the graphs that I've shown here. At the top left is the New Zealand inflation, and then the bottom left is UK, and the right side, the bigger graph, is the US inflation. And they actually seem quite similar. Inflation was high back in the 80s, for some of you who would remember that. And then it dropped, and then it wasn't really high for a number of years, until very recently when it spiked up, and it has been spiking up quite rapidly. So what has been the impact is what we'll be talking about. So moving on to international shares. Now the graph here shows the return of major indices, major share markets in the world. S&P 500 is the US share market. Nikkei is Japan, then you've got Europe, UK, and then Asia emerging markets. So the key point is that markets have been falling this year, since the start of this year, and quite significantly so, which has dragged down even the one-year return, which is the 12-month return, and also impacted the longer-term return. Now, why has that been happening? Two main reasons. One is rising interest rates, and why interest rates are rising is because the central banks are raising interest rates to attend to inflation. The interesting bit, which stands out in the present time, is that the economic outlook is deteriorating, but the economies are still growing. GDP growth is still positive. Whether or not it is going to remain positive is the debate. The ideal scenario that the central banks are trying to achieve is what they refer to as soft landing. A soft landing is where they are able to control inflation by slowing down economic growth without actually tipping the economy into a recession. Now, my opinion on that is that they are too far behind the curve to achieve that balance, and they'll have to continue raising interest rates at the pace which is going to tip the economy into a recession. Now, how bad the recession is going to be is probably another point to talk about. But why did inflation come back so suddenly and so strongly? So there has been high post-COVID demand. When COVID happened 2.5 years ago, everything went into shutdown. The factories came to a standstill. People were locked in their homes. They couldn't go out and spend money. But then they realized that they could still order stuff online. And that resulted in a return of demand for durable goods. Factories had to be powered back on. Supply chain, train, railroad networks, shipping containers, trucking, supply chain, logistic assets, everything had to be brought back online. But that lagged the demand that came back much, much faster. And because people couldn't go out and spend on services, they just focused all just spending on durable goods. And that spending was fueled further by the policy support from the government. Most governments paid out something in the form of wage subsidy here in New Zealand. Paychecks were sent out by the US government, and similar sort of initiatives were undertaken by governments across the globe. That meant a lot of money went into the pockets, while consumers did not have too many places to spend that, which saw the savings rate actually go much higher than pre-COVID levels. And it's still higher than the pre-COVID levels, despite slowly drifting down, because consumer is now spending all that money. We are getting past COVID. But all that spending is resulting in a persistently high demand while supply is lagging. Now, why is supply lagging? Supply is lagging because we've had geopolitical disruptions from for example, the Ukraine-Russia war. There wasn't much, it still isn't a lot of shipping happening across the Black Sea. I think that they have signed a UN deal now to resume some grain trade, which is brilliant, which is really going to help out the food inflation that has been bothering parts of the world. And then there is China's persistence with zero COVID policy. And what that means is Chinese ports aren't operating normally, and obviously aren't operating at capacity. And China being such a central player in global trade, that is obviously not helping the supply chain. And on top of that, we've seen some labor issues. Example, truckers going on strikes, and that has also created some delays in supply. So supply is coming back online, but it's not coming back online fast enough, and there isn't really much that can be done to expedite that part of the equation. What the central banks are trying to do is slow down the demand side of the equation. So if they slow down the demand enough, the disequilibrium of demand and supply that has created inflation is going to normalize, at least to some extent, which is going to help out inflation and ideally bring down inflation closer to more normal levels. So this reversal of policy has resulted in really aggressive interest rate hikes. And interest rate hikes are negatively, they affect asset valuations negatively. I have explained this in my previous commentaries, but I'll briefly touch upon it. Any asset is valued based on its earning ability in the future years. And how you value those future earnings is by dividing it with a discount rate to bring it in today's dollar terms. Now, that discount rate is directly related to the interest rate. So if interest rates go up in the economy, the discount rate goes higher as well. And when you apply a bigger discount to those future earnings, the value today is smaller. So assets which have most of their value, today's value, tied in future earnings, their ability to generate cash flows or earnings in the future will get hit higher when interest rates go up, which means that growth assets which may not be generating a lot of earnings today, but have the potential to really grow their earnings well into the future, will have seen their valuations get hit harder. And that's what we've seen. Now, in combination with interest rate hikes, the central banks have also reduced the money supply, which was a reversal from the quantitative easing, where they were buying off bonds from the market and providing money for it. They've reversed that, and now they're taking up money from the economy, which is again going to help slow down the economic activity. The risk that I want to point out here is that of what we refer to as a policy error. So think of it this way. An analogy would be that you get into the shower and it's cold and you want to warm it up and you turn the lever to hot water, but it's not warming up fast enough. So you overdo it and then you get burned. Something like that, where while the interest rate hikes and the reduction in money supply is going to have an impact on inflation, the risk is that because inflation is going to get affected with a lag, there's a chance that central banks will continue with their restrictive stance for too long or too aggressively, and that would choke up the economy more than necessary. But that is the that's the risk side, which is sort of like the worst case scenario where inflation doesn't go away fast enough, and we see a more restrictive stance and a deeper recession. The base case is that we will see a recession. I don't think that inflation can be controlled without incurring a recession. So I think we will see a recession, but it may be just a moderate recession and maybe a shorter one. So not really over a couple of years or so, but maybe 2 or 3 quarters, and we'll be on to the next economic cycle. And also important to note, typically when the economy goes into a recession, central banks tend to provide its support to help it come out of recession at the other end. And by raising interest rates aggressively now, they are creating that buffer to allow them to drop the interest rates when the economy goes into a recession. So my expectation is that interest rates may actually, we may see interest rates drop again in 2023, not to the historically low levels, but lower from wherever they peak later this year. Now, what to do and where to invest in this present environment? Going into a recession, obviously there is an economic slowdown that is coming, and that is in combination with high inflation. Inflation obviously can affect businesses negatively, high inflation, but businesses with pricing power will benefit because they'll be able to pass on the higher costs of their business onto their consumers. So think utilities, utilities typically can have that ability to pass on the higher cost onto their businesses. Also think of defensive and non-cyclical sectors, so consumer staples, for example, supermarkets and healthcare businesses act defensively in an economic slowdown. You would still be buying stuff off the supermarket, and you'll be spending on healthcare, even if the economy isn't really growing and you're experiencing a recession. That's just our need, not a want. So discretionary spending is definitely going to get affected, but people would still be spending on staples and healthcare. Automobiles, for example, is one sector which would get hit negatively when an economic slowdown happens, when a recession happens. People would stop spending too much on cars. That can wait until things improve. Businesses with high income and cash reserves are also better placed to deal with a recession, simply because they have been earning well and they've got a strong balance sheet. Look for businesses with low debt and high cash on their balance sheet, because those are the businesses that can weather a storm and come out at the other end. Also, these type of businesses will have the ability to acquire competition, which may be struggling because of poor balance sheet strength. So there will be some merger acquisition opportunities, and these businesses will come out stronger at the other end. So look for those. But I want to highlight here that a lot of sectors that have been beaten down as a result of these interest rate hike expectations and all, there are some high quality businesses in there, and they will be the first one to rebound when the markets turn. And when will the markets turn? Well, if the recession is coming, you would expect that the markets are yet to fall because there is a recession coming. I would point out that the markets are forward looking, which means existing uncertainties may have already been priced in. Markets started falling early on in the year when the interest rates had not started rising. And the markets had been falling for 6 months, and they have been accounting for the oncoming recession when the recession may be months away. So will they keep falling into the recession? My belief is they have already priced in a moderate recession, and while there would be further volatility between now and when inflation peaks, which my view is before the end of this year, the inflation is going to peak, and that will be the turning point for the markets as well for the next bull market. We've had a bit of a rally this month in July, but that I don't think that's a bull market rally. That's more of like the market is finding some floor. So we will see more volatility over the coming months, but essentially we might see the markets turn well ahead. We go into a recession. So I think the next bull market is going to start this year. On to the Australasian shares, it is more of the same as what I've just talked about. The economic outlook is deteriorating. Consumer spending is the key, but it is getting affected by high inflation. High inflation is affecting consumer confidence levels, which means that consumers may pull back from their spending, which is going to slow down the economic activity and hence an economic slowdown. The markets, you can see the graph at the top left, the returns have really fallen off. The New Zealand market is barely on positive even over a 3-year basis. The Australian market slightly better, but definitely have accounted for a lot of the negative news that is yet to come, is yet to occur. The economy is still growing. It is still, you go out and you look at the cafes, the shopping malls, everything is still buzzing. So it's not like the economic activity has slowed down, but the share market has fallen quite significantly in expectation that it will slow down at some stage into the future. So when the slowdown actually happens, the share market might already be looking past that slowdown and might already be on the way up. The policy reversal has been the same. I've already talked about it. It's the New Zealand bank, if at all, has been a little bit more aggressive than the global banks, global central banks, RBNZ. But it's been the same reversal of policy support. Interest rates have been increased, and the money supply has been reduced. And there is the error of policy error. And I also expect that it's going to be the same, that when the economies do go into a recession, Australia and New Zealand, the interest rates will get dropped, and that potentially would be next year. Now, indigenous issues for New Zealand include labor shortage. The borders were closed for an extended period of time, which has resulted in quite an acute labor shortage across many different business sectors in New Zealand. That has resulted in wage inflation. Businesses are forced to pay higher to hold on to their staff or attract whatever skilled labor is available in the market. Recent border opening should help, but we are yet to see whether that how much of the help is going to be, because mind you, other bigger economies around the globe have been open for much longer, and skilled migrant typically are already on their way to those economies. So how much our border opening helps, we'll see. Australia's heavyweight sectors, the banks and the miners, face headwinds. Typically, these two sectors struggle when an economy goes into a slowdown. Banks, while they benefit from higher interest rates, their interest rate margins go up, so they have the profitability has improved considerably this year. But going into a recession, typically what happens when the economy slows down, people stop taking out new mortgages, so mortgage lending goes down, businesses stop taking out new loans, business lending goes down, credit card spending falls off as well. So the profit margins get squeezed for banks, and similarly for miners. I mean, when an economy goes into a slowdown, infrastructure spending gets hit. Government tries to focus on getting the economy through rather than spend in new infrastructure projects, which may see a reduction in demand for mining resources. I have to point out, though, the Chinese economy is expected to do better in the near term because of being in a COVID zero policies slowdown recent months. So when they do move past that COVID zero policy, the economy is expected to come out of the current slump, which is going to be a bit helpful in the near term for the Australian miners. But going forward, longer term, there is a shift in focus by the Chinese government away from property and onto technology, which is not going to help the longer term demand for iron ore, for example, for Australia. Now, what to do? Where to invest? Again, businesses with pricing power. It's more of the same. Something specific would be, tourism, hospitality businesses may see a boost during the oncoming summer later this year as tourists arrive again. Borders hopefully will remain open, and if that happens, there will be a boost in revenue compared to what these sectors have gone through over the past couple of years. Again, markets are forward looking. I've touched upon the markets have fallen quite significantly, so a lot of the oncoming negative news has already been priced in, and I would expect the markets to turn around before they actually, the economy is going into a recession. Infrastructure is probably the only asset class which has done pretty well over this recent time. You can see the quarter's positive, the year is very, very positive, and even the 3-year return is good. The 3-year return is a bit subdued because remember when we went into a lockdown globally, nobody was using infrastructure assets. The toll roads, the bridges, airports, all of those came to a standstill. So infrastructure lagged in the recovery, post the COVID sell-off in 2020 and then 2021, and then slowly started to pick up late last year. But then this year, as the world has continued to move past COVID, the international travel has continued to return, which is helping, and I expect that to continue to return. People still are very eager to go on vacations and travel to their loved ones across the globe, catch up with family and friends. So I think international travel is going to continue to improve. There is more traffic on the road. We are back to the rush hour traffic jams that we had pre-COVID. Which tells me that toll roads and bridges are also seeing a lot of traffic, and hence the revenue is higher for those. Energy infrastructure has benefited from higher oil price recent months, but going forward, typically the price of oil also would fall if the global economy goes into a slowdown. When economies go into a recession or a slowdown, the demand for oil gets subdued, and that is going to result in lower oil price, and lower oil price means lower revenue for the energy infrastructure. So look out for that. Utilities infrastructure is pretty defensive. People still would use water and electricity during an economic slowdown, and it had stayed stable even in the face of COVID. People were still using, utilities. So utilities infrastructure is a safe place to be. But in general, infrastructure is a defensive asset class within equities. So for those who are wondering or looking for defensive places, infrastructure is not a bad place to be. Now, property is interesting, and I'll talk about listed property here because that's what we invest in for our investors, for our clients. It has taken a hammering. You can see that to the point where even the 3-year returns are negative. The global listed property is barely positive even for a 3-year return. Higher interest rates are negative for valuations. I'll explain that. But on the flip side, the yields are attractive typically for property. So the running yield is a point of attraction in combination with lower valuations that we have seen, we are witnessing now. So for those of you who are sitting on cash and looking at listed property, property investing, listed property is probably not a bad time to invest in it because you've got valuations which are really low and yields which are consequently higher. Specifically talking about subsectors of property, office is facing some headwinds, structural headwinds from working from home. There's a greater tendency of people working from home at least part of the week. So the demand for new office space development is going to be subdued or will come at the cost of existing office developments. Industrial sector continues to see demand because of supply chain disruptions. Supply chain is lagging, which means greater demand for warehousing, which is what industrial assets are. So that is a bright spot within property. Hospitality is dependent on the border control. The borders are open, so hopefully, we will see a pickup in the revenue for the hospitality sector and retail too, for that matter. But then retail faces structural headwinds from the advent of e-commerce, which just got a boost during COVID. Everyone got introduced to e-commerce, and that is going to continue on. So any retail business that hasn't got an e-commerce presence is going to struggle, into the future. Well, I would talk about residential property because that is, one of the biggest favorites for Kiwi investors investing in houses. What I see is a very dim outlook for housing in New Zealand, investing in residential property, and that is. I'm not going to go into a lot of detail. Anyone who is interested in investing in residential property would already be aware of the rising mortgage rates, the new tax laws, the tenant-friendly policies that the government has introduced, the migrants, which drove the demand early or mid to 2010s. They haven't been there because of the borders were shut, but also because I say that other economies have been open and migrants have been going there rather than looking at New Zealand. Skilled young Kiwis, particularly the expats who return from overseas during the time of COVID, are already looking for those opportunities, overseas. So those would typically fall within the first home buyer category, and they are. If they are looking at overseas opportunities, they are obviously not going to be interested in buying a house here. With higher mortgage rates, obviously, think about investors with 10, 15, 20 properties or more. They'll be looking to consolidate their portfolios into their profitable properties rather than the non-profitable ones, which is going to be creating a lot of listings over the coming months. And who's going to buy? Well, existing properties are not going to be touched by existing investors because of the new tax laws. The first home buyers, as I've said, the migrants aren't really coming, and the existing ones are looking overseas. So I think there is going to be a shift in demand-supply imbalance, and we might be in for a rough ride for residential property investment over the near to medium term. The silver lining to all of this scenario is the next year election. If National comes to power, which they might, there is a chance that they could repeal the tax laws and that could change the dynamics of property investing again. So watch out for that. Now, international fixed interest and fixed interest in general has been negative, as Joyce pointed out early on. It has been one of the worst bond markets in a long time, and it's very unusual to see a negative return associated with 3 years in fixed interest. Fixed interest is generally defensive, but what has been the case, because interest rates have dropped to historically low levels, near zero levels, and now they have been rising from those zero levels up to more normal levels. So that has really hit the valuations hard. At the same time, quantitative tightening, which is the opposite of quantitative easing, reduces demand for bonds. In quantitative tightening, the central bank is selling bonds and buying up, taking up money, which is increasing the supply for bonds, which is lower demand. In this environment, why would you be looking to invest in fixed interest? Again, markets have already priced in a lot of the impact of these negative factors. The higher yields, there'll be higher yields because of the lower valuations that we have seen for bonds. So low valuations typically equal higher yields, which is something that is going to compensate investors in the turbulent time. So higher yield is a defensive trade, which is going to help out if there is turbulence on the equity side of the portfolio, which is what typically you would have achieved by investing in fixed interest over the longer term. But recently, the past 2 years, that has not been the case. Nevertheless, despite falling, the volatility in fixed interest is still lower than shares. So, they still provide that defensiveness in lower volatility. And as I said, that interest rates might drop next year, which is going to provide support for valuations. When that happens. New Zealand fixed interest, similar to global fixed interest, very negatively, affected by rising interest rates, and you can see the returns are negative for 3 years as well. RBNZ is seemingly more aggressive. They have come out and said that we are going to not stop unless we get inflation back within our target range, which is 1 to 3%. At 7.9% or 7.3%, that's what it is right now. It is going to take some time for it to come down, particularly because of some exogenous factors that may not allow inflation to fall quickly, which means that interest rates may continue rising longer than neutral levels, which is not really helpful for valuations. But on the flip side, lower valuations equal higher yield. So for someone who's not been invested in bonds, this may be a good time to look into it because of higher running yields. New Zealand dollar. So New Zealand dollar, the near-term outlook depends on what the respective central banks do. So if RBNZ is more aggressive than the US Federal Reserve, then we will see New Zealand dollar appreciate. But consequently, if the US Federal Reserve turns out to be more aggressive, then the US dollar has been appreciating because they have been a lot more aggressive recently. RBNZ, mind you, started out earlier than US Federal Reserve. So US Federal Reserve is trying to catch up, which has pushed up the New Zealand dollar against the New Zealand dollar recently. But in the longer run, once we get past the economic slowdown, typically being a commodity currency, we would see New Zealand dollar appreciate when the economic activity picks up at the other end of a slowdown. I would point out the term deposit rate, the graph that I've shown at the bottom right. The term deposit rates have started to pick up, which is great for term deposit holders. But mind you that the term deposit rates are still way below inflation, and it is hard to imagine that they would cross over inflation and provide a real return. Being below inflation means that you are definitely moving backwards in real dollar terms. So while share markets have fallen, they have a tendency to turn around very quickly. Term deposit rates do not go up quickly. They're a cost for the bank, and the bank is not going to increase their cost in a hurry. Now, to bring it all together, what you need to do is have a diversified portfolio. So not just invest in term deposits or property or direct shares. Have managed funds, which will be a combination of different types of assets across different geographic regions, across different asset classes. And the beauty of that is, the graph on the right side is just an analogy. If you've got umbrellas and sunscreen and you invest in one of those, you would see volatility based on the season. But if you invest in umbrellas and sunscreen, well, they will sort of offset each other, and your returns, the diversified portfolio, would be, like a yellow line. It's not going to be a straight line, but you get the picture. That's going to be a lot more stable. Now, this graph is important because I've shown relative returns for different types of assets over the last 30 years. And the best performer at the top is the US shares. And then you've got all countries, which includes the emerging markets and other developed countries. And then we have the green one is actually New Zealand property. So New Zealand property has seen a really strong period over the last 10 years or so, and that has resulted in that being the better performer than New Zealand shares, which has, because of the recent drop, has now dropped below New Zealand property performance over the last 30 years. And then Australian shares, and then term deposits and inflation. So what I want to highlight here is that share markets go through these up and down movements, but if you are invested for long enough time, you will end up doing really well, if you are willing to go through the short-term volatility. And the same thing is shown by this graph, which is actually looking at the last 75, 80 years, almost 1942 to 2020, 2022. The last 80 years, the US share market has seen a lot of these bear markets, and bear market is when the market has fallen by 20% or more. Those are the yellow drops. It's probably a bit hard to see, but read the numbers. But what I want you to focus on is these yellow drops. The valleys are actually the bear markets, and the blue mountains are the following bull markets. And you can see the bull markets are far longer and far bigger than the valleys. So while the bear market is painful right now, the bull market that follows is going to, is the opportunity that lies ahead. Those are the returns for our strategies. You can see the quarterly returns are negative. The 1-year returns are obviously pretty negative. The longer term returns are not looking as pretty as they were 6 months ago, but that's the nature of this business. So, but that gives you a bit more normal idea of what the pro strategies can achieve. Yeah, so that's about it for me, Joyce. Any questions that are out there?
Yeah, we do have quite a few questions coming through, and I just want to say that the presentation is quite informative and brilliant, and I think investing is really an act of optimism, and you've showed us, given us clarity and directions, and it's reassuring to know that there are actually still pockets of economy that is going to do well, even in a recessionary environment. You have named a few. And I think, kind of reflecting on my own experience, that I have a portfolio which is invested quite aggressively, and it's probably down over 20% from the peak. Even though I'm a financial advisor, there are times I catch myself sliding down that slope of hope. You turn on the news and things are pretty negative. And in the meantime, especially on days, there are other things that's going on in my life. For example, I'm feeling pretty sick, or other things that's not going too well. You can really get caught in that negative narrative. And then it always helps me come to work talking to Shahrukh or talking to other financial advisor in my business. They help me separating I guess the noises from the signals and being able to focus on the signal, which is an indicator of the long-term trend. So all I'm saying here is, make sure that when you are feeling a little bit down or in doubt, have a trusted expert to talk to. So I'll stop blabbing on and let's look at questions. So Shahrukh, we've got a question from Tony. It's probably more of a market timing question. So he's saying that he's got money, quote unquote, I have money to invest now. Shall I put in a term deposit or shall I keep it available in cases there is a quick response needed to take advantage of a change in investment prospects?
Right. So firstly, the term deposits, as I've said, are definitely a recipe for negative return on a real dollar basis. Inflation is much higher than the term deposits that are on offer. So while on nominal basis, I haven't looked at the recent term deposit returns, but for a 5-year, you might be looking at 4%, something like that. That might look pretty attractive, but when inflation is 7%, well, you are still going backwards. For a 5-year return on the share market, I would say let's look at for example growth. Growth is still 30% defensive, and the 5-year return is 7%, despite accounting for COVID and despite accounting for the recent pullback. And if you're looking at purely shares, which is very aggressive, that's over 8%. Now, I'm not suggesting that investing purely in shares or in the share market is right for you, Tony. But I would say what we are experiencing right now is something that it's an opportunity that comes across every few years. In this previous graph I've shown the US share market going back 80 years, and there have been these valleys where share markets have fallen by more than 20%. We are experiencing this one right now. Whether it's a good entry point now versus 2 months ago, yes. Versus 6 months ago, absolutely. Will there be a better entry point over the coming months? I don't know. I don't think anybody can tell you. Maybe there would be. The markets will fluctuate, in my view, over the coming 2-3 months at least. So there might be a further low point that you can use as an entry point and use up your cash. But what are the chances of anyone nailing that bottom exactly? It is very, very normal when the markets are falling for you to feel apprehensive and not want to put money in a falling market. But that is exactly what you need to do when the market is falling, because once it starts to rise, the markets have been rising this month, but is that the start of the next bull market, or in 3 months time the market starts rising, that's going to be start of the bull market? You don't know. But what we do know is the market is lower by more than 20% from where it was start of the year. So now is a good time.
Yeah. Thanks, Shahrukh. 100%. I think market timing is extremely difficult, if not impossible. And it's a bit like I often describe to my client, it's like if you see this amazing trench coat that you always wanted to buy and it is on sale, 20% discount, do you buy it now, or do you wait until the price go back to full price? And also, just to mention that at Saturn Advice, we do have a cash DIMS portfolio, a cash portfolio, which is invested in cash and cash equivalents. The expectation is it will generate better return than just keeping money in saving account. And the practice that we use now to mitigate risk is that clients can put money into the cash portfolio and in stages invest into the chosen investment strategy into the market. So moving on to the next question. So it's a question from Graham. Shahrukh. So the question is, what asset class do you favor at this time? For example, industry sectors or countries. Now, I know that Shahrukh, you've already touched on that throughout the presentation, and you sit on the investment committee So perhaps sum it up. I mean, quick 2 minutes from an investment committee perspective, what asset classes we favor at this point in time.
Look, I've already talked about it, so not really a lot to mention there apart from certain defensive sectors for an oncoming economic slowdown. But I want to highlight here, from the investment committee perspective, the way we construct the portfolios is we would bring together, fund managers, about 15, 18 fund managers into a typical portfolio. Each fund manager would be investing in 30 to 50 companies within their focus areas, and those focus areas do not overlap, so there is no point in putting in 15 fund managers into a portfolio if they're investing in the same underlying companies. So our fund managers would be looking at different asset classes or different geographic regions or different industries within the same geographic regions, and that means that a typical client portfolio has exposure to about 500 to 1,000 companies across different asset classes, across different geographic regions, and carefully chosen companies. So the chances of a permanent loss, which is essentially what everyone tries to avoid, and what some of the attendees might recall happened in the crash of '87 when people lost their life savings. But that was essentially because the underlying companies they had invested in went bust, went bankrupt, and they lost all their money. But if you're investing in 500 to 1,000 plus companies all over the world, the chances of a permanent loss is very, very minimal.
Thanks, Shahrukh. We've got a question from Mike. I guess it's kind of continuing the theme of how we can mitigate the risk in the current market. So Mike's question is, what do you recommend for someone approaching retirement? And is this current market just too risky, or can you mitigate the risk?
Well, you can always mitigate the risk by choosing, a diversified mix of underlying companies, and how you do that is what I've just explained, a minute ago. Now, in terms of approaching to retirement, the conventional wisdom would say like, "Oh, I'm approaching retirement. I am defensive in my approach." My 2 cents to that would be, you're approaching retirement. You potentially have another 25, 30 years, hopefully more, ahead of you, until you pass on. So, that is your investment time horizon. If you've got 25 years ahead of you, that is what you need to be considering when developing an investment strategy. Not that, oh, I am retiring, I need a defensive portfolio. And as I've said, what we have experienced so far this year in the share market, that's an opportunity that repeats itself every 5 to 8 years. So we might not have this opportunity for a number of years as an entry point.
Brilliant, thank you. We have a pre-submitted question from Martin. I think Martin is on the call, and I hope that the presentation itself has kind of already answered your question, but I'm going to post it anyways. So Martin's question is, a chunk of our pension is in managed investment funds. And obviously with, the negativity that's going on, the recessionary risk, shall we withdraw these and place in term deposits? Any advice regarding falling KiwiSaver accounts?
Okay, the first question, shall you take your money out of managed funds and put in term deposits? Absolutely no, simply because that would be crystallizing the losses that you would have accumulated. I don't know which managed funds you've invested in, but typically if it's a diversified enough managed fund, the chances are that they would rebound when the markets do turn. And as I said, that I expect the markets will turn within the next few months. It's not, the next 2 years that we are going to continue to see negative returns. Moving on to term deposits, it's out. What was the second? Oh, the KiwiSaver. So again, same thing for KiwiSaver. If you have invested in, say, a balanced or a growth KiwiSaver, and you would have seen your balance go down, do not change it to conservative at this stage. Now is the time when you take on more risk, because the markets have provided this opportunity to invest in assets at a discount. As Joyce has pointed out, it's the investments are available at a discount to where they were 6 months ago. So now is the time when you put money into it rather than take it out and then wait for the prices to come back on and then you go back into it. No, now is the time when you, if you are sitting in cash or you're sitting on conservative, this is the time you increase your allocation to risk assets. If you've already invested in risk assets, sit tight. It will turn around.
Yep, absolutely. I think you don't want to miss out that market rebound, and the good days tend to be clustered together. And if you miss that initial rebound, you are leaving a lot of profit on the table. And also, Martin, I just want to mention that in the earlier slide, when Shahrukh went over Saturn Advice structure, he mentioned the business national capital that's sitting under our business. It is basically a KiwiSaver digital advice business. And the reason we purchased it last year is because we know out there are a lot of KiwiSaver accounts that's sitting with banks or fund managers where clients are not really getting a lot of advice and ongoing support. So, feel free to hop onto the National Capital website, do a health check, look at if you're in the right type of, if you're with the right type of provider, and one of our KiwiSaver specialists can get in touch with you, and they will be there to provide ongoing support if that's what you need. We've got, we're getting close to 11 o'clock. I'm just going to throw in one last question. It's a question from Selena. So her question is that she's got like a large lump sum paid out during this period, and it's quite specific. The question is 66% of current investment looks like split between moderate balance growth fund, which is already fully invested. So how would one invest a lump sum over 100,000?
How different would it be compared to $1 million? I mean, it's the same thing, same principle. Really, it's just what I've just pointed out right now, that invest in a diversified portfolio. If you are struggling to do that yourself, reach out to a professional. We are here to help. Don't hesitate to get in touch with us, and we can have a look at your specific circumstances and what you're trying to achieve. Here are the details for the business as well as me. So, yeah, reach out to us.
Brilliant. Well, thanks to everyone who listened in. I hope you got as much out of that as I do. Now, time is quite precious. You've decided to spend an hour with us. And I'm sure it's not because you've got no better things to do. So there is most likely a genuine need. And whatever that need is, talk to us. We're quite happy to help. So just to make things easier for you, I'm just going to bring up a poll. So it is, if you could quickly just let us know if you need a free, no obligation consultation with Shahrukh. It doesn't have to be Shahrukh. Some of you guys may already have a existing financial advisor who is looking after you. Answer yes, we will find out who that financial advisor is, and we will get that person, that Saturn advisor, to get in touch with you. I'll just give you guys a couple of minutes to complete the poll, and we've got Shahrukh's and Saturn's detail in front of you. If you have any questions or need help with your financial planning, please do not hesitate to get in touch with us, and we look forward to seeing you at the next webinar. Thanks, everyone.
Thank you, everyone. Take care. Stay safe.